This is Callie Persall, editor of Institutional Investing in Infrastructure, and joining me is Ben Holthus of Montgomery County Employees Retirement Fund. Ben is going to discuss setting up a co-investment process for an infrastructure portfolio. But before we jump into it, Ben, can you just introduce yourself and share a little bit about your role at Montgomery County Employees?
For sure, yeah. So I've been with Montgomery County about 2 years now. I help co-lead kind of the private real asset portfolio, and I also opportunistically and as I have capacity underwrite private equity, private credit. So generalist private market allocator. I've also, like you alluded to, set up the co-investment portfolio this year. So that's been a big focus of mine. These underwriting it and learning about co-investments and how we would execute on them the last year, and now actually executing on them and building and implementing that portfolio.
So, when it comes to infrastructure investing, what would you say are some of the key differences between investing in primary funds and co-investments?
Well, it really depends on how you approach co-investments. For us, it isn't all that different, primarily because we're only co-investing with managers that we have already invested in their primary fund. The way that kind of came about is about 2 years ago, it became clear there was a big opportunity in the market. What we're seeing is that infrastructure investors or funds are prolific co-investors. Basically, every infrastructure fund we were meeting with would offer co-investments potentially on every single deal, if not most of their deals. So the overarching idea was that you could essentially build a representative co-investment portfolio that owns the same assets you already owned at no fee, allowing you to average down the fee profile of your program. It's a pretty simple idea and concept, but as some people might know, and co-investments are pretty complex, so it requires quite a few amount of things. The most important things I would say is probably you really need the right governance structure and a supportive board. You need a fairly supportive primary commitment process that you can really kind of leverage then to do co-investments off of. You need a thorough but still quick and responsive kind of uh, process that kind of outlines how exactly you will execute on those co-investments with parameters of what you can and cannot do. But the process still needs to be flexible enough to handle all the nuances that can come with co-investings. And you want to ideally design it to be pretty intelligent as well. We would ideally don't want to be kind of a simple off-taker of co-investment. While I think that still can work. We want to maintain kind of like a deal by deal approach still, but the idea is that it's structured around that discretion, structured around a veto right. So it's more of a risk control rather than a selection device. It's not just me being able to go out on a whim and saying I do or don't like any certain deal.
Thanks for breaking it down so nicely there. So, what do you say some of the benefits that co-investing provides compared with raising a larger primary fund?
Yeah, it's a good question, right? Because it's like, why would a GP offer this up for no fee when they can generate, management fee and carry interest off of it? And I think there are legitimate reasons, and they're, especially evident in infrastructure. For infrastructure specifically, I would say it's because infrastructure is really a kind of a success-based or milestone-based business. The companies you're investing in, especially the stage we're investing in, which is a kind of lower middle market, the businesses are often being totally transformed, right? The end product, it could be, unforeseeable at the onset of investment. You're developing new facilities, identifying new acquisitions or mergers, entering new end markets. So really the capital need is largely variable, and co-investments allow them to respond to that. There's obviously, other benefits like infrastructure assets are larger, so it allows them to be more prudent and deliberate about portfolio construction. And then frankly, I think it's a way for smaller managers to attract large and sophisticated LPs that really need co-investment to be able to provide the scale necessary for them to invest in that fund.
So, you mentioned infrastructure being unique in some ways. Are there any other nuances that you can think of that make infrastructure portfolios different than other asset classes in regards to setting up co-investments?
one of the fundamental risks of a co-investment is like adverse selection risk. Why is this deal being offered to co-investment, but not others? And I think that's really largely mitigated in infrastructure where you're getting deal flow potentially for every deal. So two of our co-investment partners have offered co-investment on every one of their deal, where that's really not the case in other asset classes. Specifically like private equity or venture capital, where it's more capacity constrained. You may only get co-investment on one deal, and you have to ask, why is this deal being offered co-investment? Alternatively, in real estate, you're not kind of getting the same fee savings. In infrastructure, we only do deals where no management fee, no carry. Kind of real estate, it's typically half carry, half management fee. We are starting to see in real estate now that they'll kind of offer maybe just like a separate co-investment fund that you can just participate in. I think that might be a way of accessing co-investments through in real estate. So I think you really need to have kind of different approaches for different asset classes, but it's all really kind of evolving. So it's new and exciting to see how the things will develop. Probably the biggest risk, staff selection risk. Why did you select this fiber deal but not that fiber deal? So I think that's probably the most important to mitigate, and you really mitigate that by having like that thorough process that kind of spells out exactly how you will execute on those opportunities. That way, at the end of the day, if something goes wrong, it's not just me going out on a limb and picking investments, me following a process, and then really being able to utilize that discretion on the margin as those nuances come up to be able to handle that. And the last one's probably headline risk. That one's pretty hard to mitigate. It's probably pretty hard to even define. Headline risk could be a lot of different things to a lot of different people. But that one, I think you largely mitigate that right through co-investing with only the managers that you've already underwritten for a primary investment, right? You've done a lot of work on that onset before even getting access to that deal flow, rather than kind of looking at the whole universe where you might do in co-investing. You think it's a great opportunity, but you know nothing about the manager. You've done no work with them. So that's how you kind of mitigate that risk.
Broadening the perspective a little bit, what are some of the different approaches LPs can take to access co-investments in infrastructure?
So it's a spectrum. I would say every LP really kind of has their own approach. But most LPs, I would say, kind of fall somewhere in the middle of the spectrum. There's not too many on the outliers. The one end of the spectrum is kind of the most direct, the most sophisticated. So you think the Canadian pensions who've been direct investors for decades. That's what you kind of call the co-underwriting model, where you'll work directly with the manager to underwrite deals, and you'll kind of say, no, they should be using this assumption, not that assumption. But frankly, I don't even know if I would want to do that approach. For one, you need, full dedicated staff, industry experts. And even if you are an expert, you're essentially then saying, I knew better than the manager, kind of piercing that veil a little bit, which is what you hired that manager to do. So you're kind of like, why hire the manager if you're just going to tell them what to do? And then on the other end, you kind of have like SMAs or co-investment funds, and there's kind of two problems. The main one is you're giving up some of the fee savings, right? A lot of times, a pretty significant amount of the fee savings, and that's really the whole objective of the program, right? You generate alpha and co-investments through fee savings, not through picking better investments. It would be nice, and we think we likely will, but generally you can generate pretty substantial objective value add just by kind of averaging down the fee profile of your program. So you give that up on that one end of the spectrum. And you also, with that end of the spectrum, you're investing in potentially the whole universe of co-investments. So again, with managers you don't know, you haven't underwritten. And then I guess the third problem with that is they're acting on behalf of all their clients, not just you, right? So there could be an inherent conflict of interest. We've done co-investment programs with managers in the past, and maybe you bring them a great deal and they agree it's a great deal, but they can't get access for all their clients, so they don't do the deal. So there's really that an inherent conflict of interest with kind of using an SMA or a co-investment fund.
That's great. Thanks so much for talking about all these different aspects of setting up a co-investment process. Is there anything else that you wanted to add today that we didn't cover?
I mean, I would just say generally, everyone should kind of spend some time, hopefully, analyzing it. It is, I think, if you're going to be investing in infrastructure, you're kind of doing yourself a disservice if you've not even tried to look at how you could implement a co-investment process. So my message is just you don't necessarily need to be the largest, most sophisticated LP to be able to access co-investments. You might not be able to do it in the same manner, but there likely is somewhere on the spectrum that you could fall where you can still access co-investments in a prudent manner and kind of really generate some substantial fee savings. Why I'm so excited about co-investments is right is it's an objective value add. As allocators, we're typically dealing with subjective measures of value. So think private equity versus venture capital. Like I could think one way or another that those will add value, but paying less fees on the investments you already own is an objective value add to that program. So being able to kind of generate those fee savings and add that value in an objective manner is pretty exciting to me.